And welcome back for the third installment here in this week's discussion of 5 critical concepts for self-employed people. So let's do a quick review. On Monday, we covered legal entities. There are 4. Right? There's no legal entity. You don't need to register an entity to have your business, to be self-employed. The second is an LLC, a limited liability company. The third is a partnership, and the fourth is a corporation. Then yesterday on Tuesday, we talked about the 4 tax structures and how each of those legal entities defaults into one of 3 of those structures. So having no legal entity or having a single member LLC defaults to a sole proprietorship, which you then report on a Schedule C. It's an attachment to your personal tax return, your Form 1040. Then you have a partnership, which a partnership or an LLC with more than one member, a multi-member LLC, defaults to a partnership unless you're a married couple in a community property state, and then it can default to a sole proprietorship if it's a multi-member LLC and the only 2 owners are a married couple and you're living in a community property state. The state I'm in right now, Florida, is not a community property state. So even if a married couple, I didn't say this on Tuesday, but even if a couple is married and files jointly and they're both co-owners of an LLC and they're not living in a community property state, then that entity defaults to a partnership, which files its own separate tax return called a Form 1065. The third legal entity, a corporation, defaults to what we call a C corporation. A C corporation is, think the structure, the ownership structure of big businesses with stockholders and different classes of stock. Owners receive dividends as their return on their investments. And then the fourth tax structure is not the default for any type of legal entity. It's called an S corporation. You have to elect S corporation status for either an LLC or a corporation. So you first have to form the legal entity. You have to register the entity with your state, either an LLC or a corporation. And then you fill out what's called the Form 2553, and this elects S corporation status for your business with the IRS. So why would you want to do this? Why would you want to elect S corporate status? This is a question that comes up a lot because an S corporation has become probably the most popular tax structure. And if you combine that with the legal entity, an LLC taxed as an S corporation has become the most common form of business from a legal entity and a tax perspective today. That's the most common. Most businesses, the overwhelming majority of businesses that you see are LLCs being taxed as S corporations. So why are they so popular? In order to understand that, we have to think about how self-employed people are taxed. And this is thinking primarily from a federal perspective, because like I've said, what happens at the federal level in terms of taxes tends to trickle down to the state level. So we're primarily concerned with what happens at the federal level, and then states, for the most part, set up their tax system to draw off of that information. So we need to understand what happens at the federal level with an S corporation, and really with how any self-employed person is taxed in order to understand why the S corporation, an LLC taxed as an S corporation, has become the dominant form of business in the US. There are 2 main types. There's lots of different types of taxes when you combine federal, state, and local. But there's 2 main types of taxes when we're dealing with the federal level that self-employed people need to worry about. The two major ones. The first one is income taxes, and this is true of self-employed people as well as regularly employed people. Income taxes, but then there's also another kind of tax called self-employment tax that self-employed people pay. There's another name for self-employment tax. It's also called payroll tax, and it depends on your situation. If you're self-employed, you pay self-employment tax. If you're employed, you pay payroll tax. But they end up doing the same thing, and we'll talk about that more in a little bit. But first, let's talk about income tax, because everybody wants to save money on their taxes, right? Nobody wants to pay more in taxes than they have to. Now, some people, for political reasons, might want to see taxes go up in order to provide more services, either at the federal, state, or local level. We need some more services from government, therefore we should collect more taxes in order to pay for those things. That's one argument, but nobody would sit there and calculate how much taxes they owe based on all the forms and the current tax rates and say, you know what, I'm going to pay more than that. Nobody in their right mind does that. So everybody wants to pay less taxes. With income taxes, there's only two ways really to pay less income taxes, and that is either to make less money, have less taxable income, right? Or to spend more money on tax deductible expenses. So what do we mean by taxable income? Virtually all income is reportable and taxable. There are some very specific kinds of income that are either reduced in terms of the taxable portion of them or are non-taxable. But these are special cases. In general, income is taxable. So one way to reduce your taxable income and therefore your income taxes is to just make less income, make less money. Most people don't want to do that. At least for most of their working lives, they don't want to make less money. We want to make more money. Another way, the other way you can pay less taxes is to pay less income taxes, is to have more deductible expenses. And this is true both of businesses and individuals. If you spend money on tax deductible expenses, then you can reduce your taxable income that way, but it has to be deductible. There are four kinds of ways that you can reduce your taxable income. And again, this is thinking at the federal level, and this is thinking in terms of personal taxes. So this is what goes on your Form 1040. There's four ways you can reduce your taxable income. There are adjustments to income, there are deductions, right? There are refundable credits, and there are non-refundable credits. And those are really the only four ways you can reduce the taxes that you're going to pay. Adjustments and deductions reduce your taxable income and therefore reduce your tax liability. Credits, refundable and non-refundable credits, reduce your actual tax liability. Credits in general are always going to be deductions and adjustments. But those are really, and all of those are tied to spending money on deductible things, except for one deduction that I can think of and one credit that I can think of. The one deduction that you get regardless of how much you spend on deductible things is the standard deduction, and really that's kind of a weak example, because if you spend enough on itemized deductions, then you take the value of those itemized deductions if it exceeds the standard deduction. But you can never deduct less than the standard deduction, regardless of how much you spend on deductible things. So in a way, the standard deduction doesn't depend on how much you spend on deductible expenses. You can only deduct more than the standard deduction. And the one credit that doesn't depend on how much you spend on deductible things is the child and other dependent tax credit. And this is going to depend on how many dependents and the ages of those dependents and your relationship to those dependents that you claim. And you don't have to prove that you actually spent certain amounts of money, and the amounts that you spend don't determine the amount of that credit, just that dependent relationship. Now, that dependent relationship exists because those individuals are financially dependent upon you to some extent. And so therefore you have been spending money. You just don't have to show a calculation that's based off how much you've spent in order to get those credits. Now, something that we have to explain, I'm gonna get some paper here. Something that we have to understand in terms of income taxes and how income taxes work in the US is that we have what's called a progressive tax system. So if you think about something that looks like this, right? A stair step system, right? And if you go along the bottom here, so the further you move to the right, the higher your income, right? So we have income moving from left to right. The further out to the right you are, the more taxable income you have, okay? Now you'll notice this is a stair step here. So what happens is at each point that the stair goes up is a certain threshold of income, right? Make sense so far? Okay, so we have this stair step system and your income is going up as you go to the right. All right, so I'm just going to make up some numbers here. This isn't actually what happens, but the mechanics are exactly the same. The numbers are just slightly different, but the mechanics of what happens is exactly the same. So if you can understand this example, you can understand the way it actually works. So let's just make easy round numbers and say this first step will go up at, let's just say $50,000 of taxable income. The next step will go up at 100,000 of taxable income, and the last step will go up at 200,000 of taxable income, right? So as your income goes across to the right, your income increases from 50,000 to 100,000 to 200,000. Now, when we go up in the steps, this is going to be the tax rate. All right, so notice what's happening here is that as your income goes up, the tax rate for that range of income goes up. So let's say this first step here is just 10%, a nice even 10%. We'll say at the next step, it's going to go up to say 20%. Right? So this step here is 20%, and we'll just call this step 30%, and this top step 40%. So what we have here is 4 steps, right? 4 steps to where your income is going up as you move across, right? And then your tax rate is going up as you move across. So notice what happens. Let's say you have for a year a taxable income of $50,000 exactly, right? So your taxable income is going to be right there. So how much tax, income tax, are you going to pay on that $50,000? You're still, all of that income falls under that first step at 10%. So for that level, right, 50,000, 10% of that is going to be tax. So that's 5,000 in taxes, right? 10% of 50,000. Now, what happens if you make more than 50,000? You've bumped up into the next tax bracket, right? Everything you make above 50,000 is now going to be taxed at this higher rate of 20%. So let's say you make up to 100,000. Right? How are we going to tax that now? And how much total tax are you going to owe? Right? we're not going to tax the full 100,000 at this new tax rate of 20%. That does not happen. A lot of people think that happens. A lot of people are concerned or worried about bumping up into a higher tax bracket because they think that means all of a sudden now there's a higher percentage of tax that they're going to have to pay on all of their income. It does not work that way. We have what's called a progressive tax system. You only pay the higher rate on the amount of income past the threshold that gets you at that higher rate. So in this example, if you made $100,000, you would still pay the $5,000, the 10% of the first 50,000. Then you pay the 20% on the next 50,000, right? The amount between 50,000 and 100,000. So you pay 5,000 on the first 50,000 of income. Now you pay 20% of the second 50,000, which is now 10,000. So if you make, under this system, if you make $100,000 of taxable income, then you're going to pay not 20% of 100,000, not 20,000. You're going to pay 10% of the first 50,000 and 20% of the second 50,000, which is 15,000. So you actually wind up paying less taxes with this progressive system than you would if you were just taxed flat at whatever that total amount of taxable income is at that tax rate. So you actually wind up paying less taxes than you would if this system worked the way a lot of people misunderstand it to work. It's called a progressive tax system. That means when you make more money, you pay a higher tax rate on the chunk of money you made beyond the threshold that came right before you made above that. But you still pay the same exact amount of tax on every amount below that threshold that you would have. So people who are concerned about bumping up into a higher tax rate, and so they either slow down and stop working as much and bring in less money, or they do weird things because they're so worried about bumping up into a higher tax bracket, when really they're just costing themselves money over time. Nothing changes about the amount of tax that they're going to owe on all of the amount below that highest threshold that they would have surpassed. So don't reduce your income just because, or don't give up on an opportunity to make some money just because you're concerned that it might bump you up into a higher tax bracket. It might. And yeah, you're going to pay relatively more taxes on the amount over that threshold. But for everything below that threshold, you're going to pay the exact same amount of tax as you would have no matter what you do. So don't give up opportunities to make more money, and don't reduce your workload, don't reduce your earning potential just because of this fear of bumping yourself up into a higher tax bracket. So this is how income taxes in the US works, right? By the way, you may have heard the terms marginal tax rate versus effective tax rate, all right? The marginal tax rate is the highest rate you pay overall. So in this case, you made $100,000. The last dollar, right, of that was taxed at this highest tax rate of 20%. So your marginal tax rate is 20%. Now, that does not mean that all of your income was taxed at 20%, because 20% of $100,000 would be $20,000. But here you're only paying $15,000 in taxes, right? So your marginal tax rate is not your effective tax rate. Your effective tax rate is how much of your taxable income you actually paid in taxes. Now, how much did you actually pay in taxes? 15,000 of 100,000. That's 15%. So notice your effective tax rate under this kind of system, your effective tax rate will always be lower than your marginal tax rate. Your marginal tax rate is the highest tax rate you paid overall. Your effective tax rate is how much of your taxable income actually went to taxes. And this is the number you should be interested in. For a lot of tax returns, you'll see the marginal rate and the effective rate. Ignore the marginal rate based on the logic I just talked about with you. Yeah, you made some more money, so it bumped you up into a higher marginal tax rate, a higher tax bracket. Who cares? The number you should be concerned with, the number I'm concerned with for my clients, myself, is the effective tax rate. How much of my taxable income is actually going to taxes? That's the question you need to be asking in terms of income taxes. Now, there's more to your effective tax rate, though, and sometimes for self-employed people, unfortunately, their effective tax rate might actually be very close, if not more than, their marginal tax rate. How could that happen? Because there's another kind of tax that self-employed people need to be concerned about when it comes to filing their taxes. And that's called self-employment tax. Now, in order to understand self-employment tax, we first have to understand payroll tax. If you have ever been an employee, if you're currently self-employed, but you've been an employee before, or if you actually are an employee, you know what payroll tax is. On your pay stub and on your W-2 that you get during tax time, you'll see that not only do you have federal income tax withholding, but you also have two other taxes taken out of your gross pay called FICA or Social Security and Medicare. Those are payroll taxes. FICA is 6.2% up to a certain threshold. And for 2019, it's about 130,000, something like that, 132.9, I think. But beyond that, you no longer have to pay that. So it's only on that first 132.9 that you're paying that 6.2%. But for most people, they're making gross wages less than that, and so 6.2% goes to FICA or Social Security. And then 1.45%, and there is no cap on that, 1.45% goes to Medicare. That's on the employee side. That's what you see on your pay stub or on your W-2. Employers are also responsible for the same exact amount. The employer has to pay 6.2% into FICA up to that cap, and then another 1.45% into Medicare. So the employee pays a total of 7.65%. The employer pays 7.65% for a total of 15.3%. So on top of the income tax, there's also payroll tax, which totals 15.3%. As an employee, you're only paying half of that because your employer is paying the other half. So really, if you think about compensation as an employee, add 7.65% to your gross wages, and that's how much the payroll expense for your employer is. So just by virtue of being employed, you're actually costing your employer your gross wages plus another 7.65% on top of that. Right? You may not have known that. Employers are actually paying more than gross wages in turn, and that's not even taking into account benefits, right? Which can add to those payroll taxes as well. The value of those benefits can add to payroll taxes as well. So take your total compensation, your gross wages plus your benefits, and add 7.65%, and that's how much your employer is actually out in terms of each payroll run to you. So what happens if you're self-employed, though? You don't have an employer that's kicking in their half of those taxes, those payroll taxes, and you're not running payroll to yourself because you're self-employed. So where does that come from? What happens? Do you get out of that? Unfortunately, you don't. When you're self-employed and you're a sole proprietorship, you have a Schedule C. When you calculate the net income from that business on that Schedule C, then part of that net income, right, also that number moves to another form. So you have the Schedule C where you report all the taxable income, the gross income and the deductible expenses, and then therefore get the net income of the business on the Schedule C. Then there's another form called the Schedule SE for self-employment, where you calculate the self-employment tax. And you as a self-employed person are now responsible for paying the full 15.3% of your net income from your business, because you don't have an employer that is withholding those payroll taxes from your gross pay, and you don't have an employer that's matching the other half of your payroll taxes. So you as a self-employed person are responsible for the full 15.3%. And because you're self-employed, instead of calling it payroll tax, we call it self-employment tax, but it's the exact same thing. Usually this tends to shock self-employed people. And really the fact that they're self-employed, self-employment tax, the 15.3%, that itself is not what shocks them. It's the balance due, the tax balance due when they prepare and get ready to file their tax return, that shocks them, because they don't understand where that big bill came from. That big bill came from two parts. Remember, we have the first part, the income taxes. You still have to pay those. Self-employment income is part of your taxable income. So you have to pay the income tax, and then you pay the 15.3% self-employment tax on top of that. So take whatever your effective income tax rate is, right? So if we go back to this example and say you've got $100,000 of self-employment income, net income off your Schedule C. So that $100,000 comes to you as taxable income. And there's a little bit of a variation here because you get to deduct the business's half, but let's keep it simple. Let's say you bring in this $100,000 of net income from your business. You're going to pay, again, these numbers are not correct relative to what you actually would wind up paying, but the mechanics are exactly the same. You're going to pay under this system the $15,000 in employment, in income taxes, right? The $15,000 in income taxes. Then you're also going to pay another 15.3% in self-employment income, because this is all self-employment income, right? So you're going to pay the self-employment tax on that $100,000, which is going to be another $15,300, 15.3% of that. So your total tax bill, when you finish preparing your Form 1040 tax return, is going to be the $15,000 of income tax plus the $15,300 of self-employment tax. So on $100,000 of income, you're going to wind up owing over $30,000 in taxes. And a lot of self-employed people do this, and they prepare that return themselves, and they can't believe that number. They don't know where that number came from, especially if they're coming from being an employee where the employer was paying its half of the payroll tax, where the payroll tax was taken out of each paycheck, and they had federal income tax withholding coming out of each paycheck. And so you get a lot of employees that were used to getting refunds every year when they filed their taxes. And now all of a sudden they're self-employed for a year and they file their taxes and they wind up with $20, $25, $30, $40,000 tax bill. And they can't understand where it came from. It came from the fact that throughout that year, because they were self-employed and therefore there was no payroll, there was no employer to run payroll, they didn't have any federal income tax withholding, and they didn't have an employer taking out the employee's half of the payroll taxes and contributing the employer's half of the payroll taxes. And so when you're left on the hook as a self-employed person for this total amount, right, and you've not been paying into it throughout the year, it's a big bill when you file your tax return in March or April. And this becomes a big problem for self-employed people. There's only two ways to reduce self-employment tax. Right? We talked about the two ways that you can reduce income tax: make less income, taxable income, or spend more on tax deductible expenses. Right? Those are the only two ways you can reduce your income taxes. There's only two ways you can reduce self-employment tax. Reduce your net income from your business, right? That's one, because you're paying that self-employment tax as 15.3% on the net income from the business. So reduce the net income. Now, how do you do that? Well, it's the same thing as income tax, right? Either reduce the business's income, hopefully you're growing your business, or spend more money on deductible things, right? Tax deductible things. And for a business, there's a lot more tax deductions, a lot more deductible expenses than there are for individuals. But you have to spend that money on those deductible expenses. And by the way, and this is a pretty common thing, but by the way, I've even seen bookkeeping software that gets this wrong. But as a self-employed person with a sole proprietorship, the amount of money that you take out of the business and use for personal expenses or spending business money on personal expenses is not tax deductible to the business. A lot of times you see this labeled as an owner's draw. An owner's draw is not a deductible expense for the business. Right? So, being able to use that money for personal reasons is not a deductible expense, and it doesn't reduce the net income, the taxable net income of that business if it's a sole proprietorship. Right? So, the only way you can reduce the self-employment tax, right? The first way you can reduce self-employment tax is make less self-employed net income, right? The second way is to have a corporation. And when I say a corporation, I mean a tax structure corporation. So either, and back to yesterday's talk, back to part 2, either a C corporation or an S corporation. Those are the only two ways, right, that you can reduce self-employment income as an individual self-employed person. Now, if you have a partnership, then your distributions out of that partnership aren't self-employment income, right? So that's possible as well. But in general, when we're talking about an individual self-employed person, right, that would otherwise file a Schedule C, the only two ways to reduce self-employment tax are to reduce the taxable net income from the business or have either a C corp or an S corp, a C corporation or an S corporation. As a corporation, right, you become an employee of your business as well as an owner. So you're both an owner and an employee. You can pay yourself a salary for the work you do within that corporation. Now, your salary is then subject to payroll tax. Remember, payroll tax and self-employment tax are the same thing. Right? They're both that 15.3%, right? 6.2% going to FICA for the employee, another 6.2% going to FICA for the employer, 1.45% going to Medicare for each the employee and the employer, for a total of 15.3%. Now, there's no self-employment or payroll tax on distributions from an S corporation to the owners or from dividends to the owners from a C corporation. Dividends, though, are taxable income, right? And so you're going to be taxed at your income tax rate. Only dividends get preferential tax treatment. So dividends do get taxed at a different rate than your income tax rate if you hold the stock in the company for more than a year. And distributions out of an S corporation are taxable income. So they're taxed at your income tax rate, but you don't pay self-employment tax on those distributions. So you might be thinking to yourself, if an S corporation gets me out of paying self-employment tax, it's still income tax. You can't reduce the income tax, right? But the S corporation gets me out of payroll tax, it gets me out of self-employment tax. Then why would I pay myself a salary and pay payroll tax if it's the same thing? That's tomorrow's topic. That's going to be the topic for part 4, is why S corporation owners as employees, people actually working in the S Corps they own, why S Corporation owners need to run payroll to themselves. And not just need to, but have to. Right? Why they have to run payroll to themselves and therefore pay payroll tax. And how an S Corporation actually generates tax savings for its owner or owners. That's tomorrow's topic. So if you have any questions about income taxes versus self-employment / payroll taxes, please let me know. Please comment on this video. Let me know. I'm happy to answer that. Happy to schedule a call with you to discuss. Other than that, please come back tomorrow or tune into the next video in this series for how S corporations help their owners save on self-employment tax by swapping the self-employment tax out for a little bit, not the full amount as they would have paid a self-employment tax, but for a little bit of payroll tax, and why it has to work that way. Have a great one. Thank you.